morning, everybody. Welcome to today's episode. My name is Nicholas, and I'm here with my mom, Tamara. And just a little introduction, I'm studying business admin at Georgian College. This is my second year, third semester, and I've been really interested in how the psychology works in the stock market, especially, and today we'll be talking about that. So here we go.
Thanks for having me, Nicholas. I'm excited to be here. I follow the markets casually with my husband, and I've always wondered why people make the decisions that they do.
Exactly. That's the same reason why I'm very interested in this topic. The stock market isn't just about numbers. It's all about people and their emotions and their biases and what they're going through in their day-to-day lives. So let's jump right in.
Sounds good.
From your perspective, how much of market behavior do you think is rational versus emotionally driven?
I think the majority of it is emotionally driven. I think people are as impatient as ever, and they often panic when prices drop, or they become greedy when prices skyrocket.
That's a great point. And traditional finance theories like efficient market hypothesis assume that investors are rational and prices reflect all available information. But behavioral economics shows us that emotions and biases like fear and greed often drive short-term volatility and price runs.
I believe that.
So that kind of explains the dot-com bubble and the 2008 housing bubble perfectly, honestly. Okay, we can move on from there. So tell me, why do you think even highly intelligent, high IQ individuals consistently underperform the market at times?
Well, being intelligent helps with analysis, but investing is as much about managing psychology as crunching numbers. Maybe some people overthink things, like they overanalyze too much and they miss the bigger picture.
Right. The research shows that high IQ individuals sometimes underperform because they overanalyze, overtrade, or fall into the overconfidence bias. It's not just about intelligence in the market. When you're under stress, fear, and greed, and all these emotions, social influence can override your logic and deviate you from logical decisions.
I can see that.
Alrighty, on to the next. How do you see herding and social influence impacting investors, both individuals and institutional investors?
Well, I think people follow the crowd. I think if everyone's buying a stock, people tend to feel safer when they join in. Herding and social influence also amplify collective behavior, sometimes rational, sometimes irrational, leading to market momentum, bubbles, and crashes. I know a lot of my friends and family talk about the stock market during our coffee dates, and everybody always has tips and advice.
Oh, that's honestly great insight. That's textbook herding behavior. Social psychology tells us that our peer pressure and group dynamics can be powerful amongst each other. A good recent example of that is the recent rise in GameStop and AMC, where social media communities can drive these massive price swings and drops in the markets, which is honestly nuts. All right, I think we'll move on from there.
I remember seeing that on the news.
I know, it was everywhere.
It was everywhere.
Quite literally everywhere. On social media, everywhere.
Yep.
So what kind of cognitive biases do you think everyday investors should be aware of when they're investing in the stock market?
I think the loss aversion is a critical one, and a popular one at that. Everybody hates losing money. Everybody wants to gain money. I know some other biases that likely affect investors are overconfidence, confirmation bias, and anchoring.
Right. Yeah, research shows that losses feel about twice as painful as equivalent gains feel good.
I believe that.
Yeah, nobody likes to lose. Other common biases include confirmation bias, where investors only seek information that prove that they're right or confirm their bias. Um, Overconfidence, which can lead to risky decisions. Recency bias, which is an extremely popular one in the market, which is overweighing recent news events and just assuming that everything will continue as it is forever, which has bitten me in the ass in the past.
I think it's bitten everybody in the ass in the past.
Yeah, it's a tricky one. But we'll move on from there.
Okay.
So on to the next question. How do you see behavioral economics changing the way we understand trends compared to traditional theories like the efficient market hypothesis?
Well, EMH treats markets like machines, while behavior economics treats them like people. And that makes market trends a lot more understandable. I think behavioral economics makes more sense in the real world. People aren't robots, people are emotional beings.
That makes a lot of sense. And I agree, EMH is useful for understanding efficiency in the long run, but behavioral economics, explains the short term and why we see bubbles, crashes, extreme momentum in either way. And it really bridges the psychology and finance in a way that, really reflects human behavior. And I think we've covered everything today. So this has been a very insightful conversation. And we've seen how psychology, from biases like loss aversion to social influences like herding, plays a huge role in financial decision making. The stock market isn't just about fundamentals, it's about people. And thank you for joining me today. Thank you for listening in. And I hope everybody has a new perspective on how behavioral economics and social psychology connect the world together.
Thank you for having me.
Yeah, of course.